stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zach's senior strategist, Kevin Cook. He's also the editor of Zach's Taser and Healthcare Innovator newsletters. So he's been right in the thick of everything going on here in 2022 to talk about the growth stocks. What should you do? Should you sell them now? Now that they plunged down, should you sell? Should you buy more? Should you dollar cost average, like every month or every quarter, or I don't know, every day it seems? Can you do that to save yourself if you dollar cost average? Kevin, I've gotten a lot of questions about this on Twitter and a lot of requests to have you back on the podcast to talk about it all. So what's an investor to do? This is one of the worst starts to a year for the NASDAQ in quite some time, and one of the worst starts in basically like the last 40 years. So,
yeah, since you had requests to have me on, I'm glad I'm remote and that there's nobody waiting for me at the office. This could be my purification for the sins of growth stock investing.
Well, is it sins though, or is it just, it was so good for so long, and how can you know when it's going to end? Or maybe it hasn't even ended. Maybe this is just a timeout and it's 2018. Because the NASDAQ was down big in 2018. So maybe this is just 2018 again. And, these stocks will rise back up.
Yeah, well, there are bigger sinners than others. And I would say the biggest sinners are people who just held on to a Square or Shopify or something like a Roblox, near all-time highs. And maybe they were buying on 20% dips.
Right.
But then the temptation that I fall into is thinking, okay, this stock is off 50, 60%. So now it's okay to buy, right? And then, and then it's down 70%.
Right. But what kind of advice then do you give to people who do want to buy, maybe thinking they're getting it on sale, depending on the company, but they are running across this? Should they just keep dollar cost averaging
well,
the final does bottom, or is
as always, there's a mix of skills, right? I mean, you can understand the logic of dollar cost averaging. You can have a long-term view, and then you also get to know individual companies. So I could definitely make the argument, if you like something like Shopify or Square, that you should be buying here for the long term. Okay. But I think you have an angle on this that people need to hear about the last time a tech bubble burst and how long it took for some of these companies to come back, right?
Yeah, I definitely think we can learn some lessons from the 1999 into 2000. The dot-com bubble and then the bust. I'm not saying that this is like the same situation as what happened then, but there are some similarities in terms of, 1999 was a record year for IPOs until last year. And then there was a lot of speculative companies that went public in 1999 that were probably the ones that came public in 2020 and 2021 as SPACs this time. Maybe not IPOs themselves, but they came to the public market anyways as SPACs. And there were several hundred SPACs. People don't realize how many of those there were over the last, 2 years as well, but especially last year. So that kind of, speculation, the surge in the new publicly listed companies means that you weren't getting a lot of good quality names in there. Some were, some weren't. But that's very similar to what happened in 1999. So some of the things that it does remind me of were a couple of names that I was watching back in 1999. So one of them was called Webvan, and basically they were delivering groceries. So this was a new thing back in the 1990s. We take it for granted now, But in late 1999, they launched in the Bay Area. They did have a distribution facility, and there were these vans that drove around, and you would occasionally see them outside your apartment complex because it was, the young people were going on their computers like, oh, I can order my groceries on here. And I think it might have had even like free delivery or something. But Webvan, they started delivery in June 1999. So there was plenty of free money everywhere. The venture capitalists gave them almost $400 million, the VCs groups gave, because they were in the Bay Area. They could see the concept. They liked the concept. They went IPO in November 1999. So they raised $375 million at that. And at one point, the company was valued at $4.8 billion. Well, this all sounds, pretty similar to some of the stories we've heard the last couple of years. And they had revenue. I keep getting this from a lot of people too, like, oh, the companies, in this go around had real revenue, unlike in 1999. So yeah, there were some companies that did not have revenue for sure in 1999, but Webvan was not one of them. They had revenue in 2000 as the bust hit. They made 178 million in sales, but their expenses were 525 million. So they had this disconnect, and then the bust was happening. So nobody wanted to bail them out anymore. There was no free money anymore by the time the bust began. And they ended up going bankrupt by June 2001. So they ended up losing about $800 million. This is all according to Wikipedia. And they had about 2,000 employees at one time, and they went under. But we now know that concept of delivering your groceries from a distribution center is now what we do in everyday life. So their concept was correct, just the timing was off. Then we had the bust right when they came to the public market, but they were one who didn't last. Another one who didn't last that more people are familiar with, that you might have heard of, is pets.com. Also, again, online pet supplies. That was a new thing in November 1998. So that's when they started. And they ended up, attracting a lot of attention. They had the sock puppet. People remember that little puppet on the commercials. Their tagline was genius. It was because pets can't drive. Remember?
I forgot that.
They can't drive. They had a float in the 1999 Macy's Thanksgiving Day Parade. They also spent $1.2 million on their 2000 Super Bowl ad with the sock puppet. So all of that was going well. They had sales, but they offered free delivery. Now, nowadays, we take that all for granted. Oh, free delivery. Yes, of course we're getting that. But back then, this is a new thing. And they were trying to give free delivery to things like cat litter. Well, they're not going to make any money. So they basically lost money on every item that they sold, or nearly every item. So they too did the quick IPO, but they went IPO. I do remember this because it was very late in the cycle, in February 2000. So they didn't even do it in 1999. It was right when the dot-coms, like the window to go public, was closing, but they managed to get in there. It was only $82 million IPO, but they didn't last long at all. By November 2000, so not even a year as a public company, they were already laying off most of their employees, but they did have 570,000 customers on the day that they shut down by November. But overall, from according to Wikipedia, from February to September of 1999, when they were spending all this money on the advertising and everything, they had 619,000 in revenue, but they spent almost 12 million on advertising. So the concept again was correct because PetSmart tried to buy out some of their assets after they went BK. And to this day, here in 2022, if you type in pets.com, the actual domain name, it goes to PetSmart now because they did end up buying the domain name ultimately. So we also have Chewy, another, online pet supply company. So this is another one where the concept was good, but the timing was just kind of, iffy. But I know many of the people listening out there also have a company that they bought into over the last 2 years, either an IPO or a SPAC.
Wait, before you do that one, can we just talk about the two that you just talked about in the Wayback Machine there?
Yeah, sure.
So you covered was it called Webvan?
Webvan,
yeah. And then what was it, pets.com? Yeah. So I want to make this relevant for newer investors who weren't investing back then and don't remember any of this. So why is this relevant? Well, it's relevant in the sense that we had something like a stock bubble in, after the coronavirus, and software stocks just flew higher and investors couldn't get enough of them. And it seemed like the new paradigm. We had 10 months of digitalization and we'd had 10 years of digitalization transformation in 10 months.
Yeah.
So software was the place to be, but the stocks all went too far. So we did have our own tech bubble again.
Yeah.
And so there are lessons, I think, from 1999, 2000, where you look at a company. Back then, I think the caveat for back then, there's actually two. One, we ended up going into a recession, so things stayed down longer and companies went bankrupt. But also that the web was so new that these new business models were really in the Wild West, and it was sort of that's just the way it was for investors and the companies. The companies were spending all they could, and the investors were, hey, this is a gold mine. This could be the next hot thing. And so maybe investors are better at evaluating things now, although many of these software stocks got bubblicious again in 2021.
But at least from what, from that example, the software stocks had the revenue, they were actually, they weren't pets.com where they made $690,000.
Right.
No, they they had either subscription, they're selling it. They had real revenue. So I feel like that is one of the bigger differences too between the quality of the companies that have gone public, or even just the type of bubble that we just had, say, in the software side. Like
the other lesson I want to mention, and I don't know if you're going to get to this right now or later, is that some companies that did survive and are extremely important companies today, and I think of Microsoft and Amazon as two of them. You would love to be an investor in Microsoft and Amazon a couple of years ago and caught their 50% runs higher, and maybe you want to buy them soon now. But they stayed down for over a decade, right? Like Microsoft and Amazon were nothing for over a decade after that crash.
Yes. But before we get to that, because I do want to talk about that too, because I get a lot of people on Twitter telling me, but Tracy, I'm just going to dollar cost average and I'm getting it so cheap and I can stick around 5 or 10 years. That's what they tell me. That's what they say, but that's what I said in 2002 or 2001, somewhere in there when I started buying Microsoft.
Yeah, you didn't think you were going to have to add another 10 years.
Right. But I do want to make another comparison to some of the companies now versus like the Webvans and the pets.coms of the world from back then, because there were a lot of SPACs that have gone, DraftKings is maybe one of the most prominent ones, but there's another one that I've been tracking called SKLZ. It's SKILLZ, and the ticker is SKLZ. And some of you may know this because it's like a mobile esports company. So they have an app that allows you to play a lot of games on your phone with your friends. So it's an interactive type thing. And they've slowly been growing their revenue. So they're not without revenue. They're expected to see revenue of $400 million this year in 2022. And analysts have them at 467 for 2023. So they have that, but they are still not earnings positive. They were not last year. They lost 69 cents. They're expected to lose 71 cents this year. But they went public via SPAC in December of 2020 So they went public at $17.89, and the market value at its peak, I think, was around $3.5 billion, maybe even more. And now they have a market cap of $880 million because the shares have sunk down. Year to date, they're down 69%, and they're only trading at $2.27 the last I checked on March 15th, 2022. Some of the insiders at Skills, this is how I found them, because some insiders did go in there to buy when they were, a couple months ago, they dove in, but the shares have continued to sink down. But, I'm sure some are asking, how low can this go? Well, it's at $2.27. And what will become of a company like this one that is still growing the revenues, but it's got the negative earnings, but it's clearly out of favor. But there's a lot of these types of these smaller caps. They're not in software necessarily, but more recent publicly came to the public market. So it's one I'm just kind of watching because I don't have an answer.
Yeah, and since it's relating to gaming, I'll tell people to take a look at Zynga. Zynga has been dead money for 10 years at like $7.
Right.
So, and everybody's like, oh, it's going to get bought. It's going to get bought. And it just sits there. Every time I look at it, it's $7.
Yeah, that's a cautionary tale too, right? Because it gets down there super cheap under $10 doesn't mean it's always going to rise up off that level for sure.
Can I talk about a $1,700 stock now?
Yeah,
okay.
Please do.
That would be Shopify.
Okay.
Shopify 1,700 was my target all last year when I was an owner.
Okay.
Then I got tricked out of it, and then in November, made an all-time high of 1,763.
Wow.
Yeah. Now, so that was in late November. So, and it closed out. Let's see. Here's December. So we had that sell off into December, right? But the stock still closed. The stock still closed near 1,400 in December.
Okay.
So for the thing that I wanted now that Shopify just had a 70% correction, greater than 70%, and it's trading 550. I wanted to see who my big whales were that I admire, who were buying in Q4.
Okay.
And probably some of them were selling because we've had a couple of big breakdowns in the stock here where it broke below 1,300 and then it broke below 800. So let's just look at some of the biggest holders and buyers. So one of the biggest holders is my favorite growth stock investors, Baillie Gifford, the Scottish warlords out of Edinburgh. It's owned by 19 partners, and it was an old insurance company 100 years ago, and it's just an investment institution in the UK. They have consistently been one of the largest holders of Shopify. In Q4, they sold 44,000 shares. Now that sounds like a lot for a $1,500, $1,600 stock, but they still hold 5.4 million.
Yeah, I was going to say that's nothing.
Yeah, as of December 31st. So I'm very curious to see what they've been doing this quarter. Have they, I'm sure that they didn't picture Shopify going down 75%,
right?
Or they probably would have sold a lot more.
Yeah.
So did they sell any? Or were they buying? So that'll be a good one.
Yeah.
And then another big investor I wanted to look at is Fisher. Fisher Investments.
Yeah.
Because he loves the FANGs.
Okay.
Ken Fisher, he loves the FANGs. So in Q4, he was a buyer of Apple, AMD, Microsoft, and Uber. He's buying all those.
Okay.
And his biggest positions are like Apple, Microsoft, Amazon, Google. And he's probably unfazed. He's probably still buying. But this just goes to show you that even the smartest guys in the room have definitely gotten hurt in Q1 here.
But there could be an argument made for the FANGs or even the FANG man, if you want to extend it a little bit to Microsoft and NVIDIA, that, they weren't that overvalued. They weren't like Shopify, I think, was trading at what was its PE at one point? Like it was like at least 100, right?
Oh, I never look at the PE of Shopify. I only look at price to sales, and it was trading 30 times sales at one point.
Okay, but I don't think any of the FANG mans were ever that high. No. I mean, even Microsoft was getting a little bit high for Microsoft, but it was at like 13 times or price to sales, I think 13. Something like that, right? It wasn't real bad.
Yeah, probably even lower than that on price to sales.
So, I feel like there is a difference, and people should know that there is a difference between skills, the one I was just talking about, and some of these big caps that have the revenue growth, that have the earnings. Some Shopify was more expensive on all of those fundamentals, PE or price to sales, than the FANG mans. But, all of them have pulled back, but you can see the difference. Shopify's down, 60% year to date right now versus, the FANG mans aren't down 60%, not even close.
And we should clarify or just talk about some of the how investors get caught up in the story of a stock. Right. Now, my boldness with Shopify was reinforced by Bailey Gifford because they do deep fundamental research and then they buy stuff with a long-term view. Like they want to buy stuff and hold it for 5 to 10 years. That's just the way so they looked at Shopify as being this significant player in e-commerce. Yeah. And they can they've got the deep pockets, they can sit and hold it. It's not going to hurt them. But if the average investor says, oh yeah, you got to buy Shopify because it's the next Amazon, they could be making a critical thought error. Because first of all, Amazon became what it is in the past, 7-8 years because of AWS and the cloud services, right?
Right.
That's not the e-commerce side. The e-commerce side was just sort of, cash flow to fund other things. And so it doesn't necessarily mean that, Shopify is going to, win this enormous market. Although they might eventually, there was just too much hot air in the stock price at, 25 times sales.
Well, that's the other thing. We can go back now to talk about what happened in 2000 and with some of the big names then, right? So the FANG mans at the time were the tech titans, they were called. So it was Cisco, Intel, Microsoft. Amazon was not a tech titan.
No.
Who was the fourth one? Cisco, Intel.
It wasn't Apple yet.
No, it was Microsoft. Was it Dell? Maybe Dell might have been in there.
Boy, I can't remember now.
But suffice it to say, there were 4 of them.
Yeah.
Might have been Qualcomm. Maybe Qualcomm.
Yeah, Qualcomm. Yeah, it was it. Yeah, Qualcomm. It was went to $1,000.
Right. Super insane, right? They're still around too. But I took a look at Microsoft. So because that's the one I started buying on that big sell-off. So at that time in 2000, it started to sell off. And between the beginning of the year in 2000 and, the end of that year, the shares were down 58%. And the S&P 500 was down only 10 during that. Whoa. So Microsoft came down big. Now, we were trained via the bull market of the prior decade that if you get a 58% decline in Microsoft, which was killing it still in 2000, it still had Windows, still had a monopoly on all of that this was on sale. So that was around the time I did start buying. So I'm doing what I'm sure a lot of people are doing right now, thinking this is on sale. And the next year, 2001 into January of 2002, it did rebound. It was up 58.9% that year, while the S&P 500 was down 13%, because we all dove in to, try to get the shares on the cheap, thinking, oh, that was the buy the dip, right? So we did get the rebound, but, even though you got the 58% rebound, it still wasn't getting you back to where you were if you bought before that big slide. But nevertheless, 2002 arrives. We're still in the dot-com bust. We did not know at the time, but we still were in it. A 9/11 had happened. And Microsoft ended up being down that year, 2002, another 21%, basically mirroring the S&P 500, which was down 22 for that year. So by the third year, so we had one very bad down year, a big up year, and then it was down, and then it basically was down.
So it went from growth at any price to growth at no price, right?
Yeah. Even though it was still making billions of dollars, it clearly had a business model that was working. The street didn't care. I think somewhere in there by like 2005, 2006, they decided to declare a dividend, thinking that would keep some people around investing, and they had all that cash sitting there. So I think they did like a special dividend to pay out to all the long-suffering shareholders. But I looked at it from, from 2003 to 2005. So maybe if you thought like you were real smart, right? You got in after the 3-year sell-off. So then shares were dirt cheap. Nobody wanted to be in it. I'm going to buy it here. I'm going to, I'm in at the low. But Microsoft for those 2 years was still down about 1% over those 2 years, while the S&P 500 did rebound and was up 30.
Yeah, it did nothing. It just, I'm looking at the monthly chart. It just drifted between 25 and 30.
Right. And it went nowhere. And everybody who was in it all those years trying to dollar cost average, basically like myself, I think I sold out around 2005, 2006, because I just got sick of it. I was like, no, it's going nowhere. Energy was soaring. ExxonMobil's making new highs in those same years. And I was like, I could be making money somewhere else. I'm out of here. So I jumped out after a couple of years of dollar cost averaging. So I just put this out there as a cautionary tale to all of those kind of newer investors who think like, oh, I can do it. I can buy some of these companies that don't pay a dividend, so you're not getting anything. Microsoft is not one of those now, but at the time it was not paying a dividend until, like I said, around 2005 or something is when they started. But, some of these other growth names, you're not going to get a dividend, and the stock may or may not, we don't know yet, go anywhere. It just may not. So you think you have the backbone or the patience and the discipline to stay in there for all those years, but you may probably not really have it. And, only the very, I tweet this out all the time. I try to find investors, and I ask people on Twitter, please tell me if you bought Microsoft like down there in 2003 and you held it the entire time up until now. Please, send me a tweet, send me something, because that's amazing and you're doing quite well, right? Or the same thing with Amazon. I want to talk to someone who did buy it down when it got to like $7 during the sell-off and did not sell when it went up to, $300. Because I think a lot of people who did, and there were some who did get in at the lows, did end up cashing in and have not been holding on to Amazon, or we would hear about it. Like you would tell someone, wouldn't you, if you've owned it all that time? You just would. I would. I don't know. Yeah. I know that some people on Twitter are like, oh, there's some people who don't need the accolades, but no, I would be on my yacht somewhere, because you would be rich if you had held it all that time. You just would. So I don't know, but
I think my Microsoft is going to be Square.
Okay.
Here we're looking at a stock going from 280. I thought it was going to get above 300, and we're back down to, we've been what did it do today? Oh my gosh, it's back above 100. It was kind of dicey there. I didn't know if it was gonna hold on to 100, but we had a good day, so it closed at 103. But I think it's going to take a long time for Square to come back too. And I didn't think that it would collapse like this. I thought they had a fintech ecosystem that serves small business that was so strong that it wouldn't even matter if Jack Dorsey, did something crazy like change the name to Block. Like, that wouldn't matter.
Right.
His obsession with the blockchain. But
yeah,
here we are. So this may take a long time to come back.
Well, do you feel the same way about PayPal? Because that's, similarly huge sell-off.
Yeah.
The fintech area.
The only thing I can think of that they hate these big fintechs so much is that there's so much competition coming, and there's no real barriers to entry.
Okay.
And my example is I followed this guy who he was at Goldman Sachs, and then he started his own boutique investment bank just focused on fintech. It's called Financial Technology Partners, or FT Partners. You can follow him on Twitter. And he publishes some excellent research reports for free. And one of the standout things about 2021 is it was the biggest year for private financing of fintechs. And we're talking there's thousands of fintechs out there and many dozens of unicorns. There's probably over 100 unicorns, private companies worth over $1 billion just in fintech. And 2021 saw 140 billion in deals in private financing. So VC loves these fintechs.
Yeah.
And I think that all this innovation and all this hard work from all these startups is a threat to Square and PayPal.
Okay.
They don't have moats.
So what should investors be doing here with their growth stacks?
And you really got to do your homework. I think Shopify is a buy here. I think Square is a buy here, but that's my opinion based on my homework. And you got to believe and you also have to know your worst case scenario. Like if all the new fintech IPOs that are probably going to, once the market gets healthier here, we're just going to see a lot of these unicorns try an IPO so that the investors can get their exit.
Yeah.
What are the new technologies, from a SoFi to an Upstart or whatever, could those imply another 20% down for PayPal and Square? Or do you think that PayPal and Square have enough of a beachhead and investment capital that they can sustain it, and then they'll buy those smaller companies? So you kind of have to figure that out.
What about some of these like biotech type of stocks, or like the ones that are in healthcare that have seemingly round tripped now during the pandemic? I'm thinking like NVTA, for example.
Yeah. The NVTA story just goes from great to bad to worse. I mean, it was going to be great because they were developing this network of, genetic data and testing, and they were just going to serve, they were going to create the data network of having all this genetic information, and then they were going to be that genetic testing would become this sort of life cycle thing where once a year maybe you went and got the latest new genetic test just because you were curious about something.
Yeah.
And that whole vision has completely fallen apart with their revenue growth and whatever. So yeah. And you look at ARK Genomics. I mean, that's the Cathie Wood fund, ARKG. Yeah. I mean, that's the poster child for this meltdown here. I mean, that thing is down. That fund is probably down, from its highs. It's probably down almost 50%, over 50%.
That has to be, right?
And and then that means individual names in there are down 80%.
Yeah.
So biotech is definitely on the ropes. I would say that what I just told my people is that CRISPR is going to be a big thing in the future. Now, does that mean that the stocks are going to be a great investment in the next 2 or 3 years? Not necessarily. I thought that they would be considered valuable assets and get scooped up by big pharma. But then all three of the CRISPR stocks already have partnerships with big pharma. CRISPR is hooked up with Vertex. Intellia is hooked up with Regeneron. And then Editas has had partnerships with Allergan for diseases of the eye. But yeah, so they're not going to get bought. And the clinical data proving both the efficacy and, more importantly, the safety of gene editing could be another 2 or 3 years away. So you have to have a really long-term horizon for what gene editing could be. And I try and keep my optimism up. In fact, just this past weekend, I went looking for scientific articles and blogs, and I found a great podcast by a CRISPR scientific research firm called Synthago, and they had some guests on there, some scientists who are just really excited about the developments in CRISPR, and not just in CRISPR, but how CRISPR relates to mRNA, messenger RNA, and how it relates to CAR T therapies, immuno-oncology, chimeric antigen receptor T cell technology. So there's so many cool things happening because they're learning to use these platforms in conjunction with each other. So listening to the scientists, you get really excited, but it's still a long-term horizon. So I would say if any investor wants to touch biotech, that they could buy the XBI right now, which is the equal weight biotech ETF, and that way you have more exposure to the small companies. Right. And you could even buy ARKG, and I think that Kathy Wood's going to pull it off eventually, and so like she's buying a company called Adaptimmune down here at $10. She's been buying, like last week, I swear she was buying like 400,000 or 500,000 shares a day.
Well, yeah, it makes more sense to be in some kind of ETF for these.
Yes.
The same way I would have wanted to be in an internet ETF after the .com bust, because you don't know who's going to be the web van and who's going to be the Amazon. You didn't know. So if I bet only on web van and not Amazon, I got burned. But if I bought the ETF, they might have still owned both of them, but at least they had one of the winners in there. So yeah, it makes sense to want to buy the ETFs here. What about some of the growth stocks outside of tech or biotech, like some of the restaurants like Chipotle? That's pulled back big. Should investors be, these guys have been around a while. Should they be taking a second look at some of these on the sell-off? Or
yeah, I don't know the valuation for Chipotle, but I would say, if you want exposure to quick service, eating, that's probably a pretty good play because they've got a quality model, that they can easily replicate. It looks like it's found some good footing near 1325.
Yeah.
And back up near 1500 today. So, some big investors are seeing opportunity here.
Just kind of wondering on some of those, other names that got stretched a bit during the pandemic and that are also coming down. So do you have any final advice for anyone out there?
I mean, it's, we always got to go big picture too. Okay. You want to answer questions like, is the economy in bad shape? Is it decelerating so fast that we're going to risk a recession? Because then stocks can still go down a lot more. And I think the answer to that question is low probability. I think the economy is humming along, so that's good. Monetary policy. Well, monetary policy is not exactly a tailwind right now since, and we'll find out a lot more tomorrow when the Fed comes out with their meeting. But, the projections are that they might hike 6 times. And, a month ago, Deutsche Bank thought they were going to do 50 basis points tomorrow. They're not going to do 50 basis points tomorrow because the stock market has come down so much, and we have the tragic war in Ukraine right now. So, the Fed's going to be more cautious, but it'll be all about their forward view of GDP and inflation, because that will tell us how many more times they want to hike this year. And if they're so worried about we've had these temporary spikes in inflation of 7, 8, 9%. If they really think that they need to, rates need to go a lot higher to stave that off, I think that's jumping to a big conclusion that's, not there. And they'll just take it week by week with the data. So, so given that the economy's fine and the Fed's not totally trying to slam on the brakes, it's a good time to be an investor still. And you're getting a lot of stuff on sale if you do your homework.
Yeah, for sure. Yeah, I have a wish list that's about 35 to 40 stocks right now.
Wow.
Yeah. That, it's a good time for value investors.
Yeah.
But a lot of these, some are the growth names that's pulled back, but even some of the value stocks have gotten cheaper in this sell-off. They've been selling off too. So why not get some of them even cheaper? So yeah, people should be keeping their lists out there. Okay, so let me recap some of the stock tickers we talked about. There was Shopify, ticker is SHOP. Skills is SKLZ. We mentioned Zynga, ZNGA. There's Block, formerly known as Square, ticker SQ. We talked about Microsoft, MSFT. PayPal, PYPL, Amazon, of course, AMZN, NVTA, NVTA, the ARKG is ARKG. The other biotech ETF that Kevin mentioned is XBI. And we mentioned Chipotle there at the end, CMG. So as always, you want to be sure to subscribe because we're trying to answer all your pressing investing questions during this pullback here. And there's always things to talk about and things going on. And I'll probably have John Blank on soon enough to talk about the economy like I always do. So you don't want to miss a single episode. Be sure to subscribe on Apple Podcasts. We're on SoundCloud, of course. We're on Spotify and Amazon Music, but get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.